Hi there. Hello. This is Aubrey Chauke. I'm a tutor for accounting, business studies, EMS, as well as research. If you're watching this lesson, definitely at the right place. Please don't forget to hit that subscribe button on your bottom right and also like this video, as this helps us with the algorithms. Through your liking and comments, we're able to know the kind of videos that you prefer so that we can be able to shoot more of them. With that being said, let's also address some issues that might be of concern. Firstly, I'd like to put it out to you guys that you might be able to see that the lighting of this video is not at 100% accurate, and this is because we're facing some load shedding, and that issue is out of my control. Hopefully, ESCOM will be able to sort that out so that things can be back to normal. Secondly, I've been unable to shoot lessons because of academic commitments, and I was also doing some teaching practicals which were taking a lot of my time. With that out of the way, let's get into the lesson of the day. Oh, and before I forget, let's just wish our lovely matriculants success for their examinations. If you need anything accounting related, holla at me. With that being said, let's go into the lesson of the day. Today we're going to be talking about, tonight we're going to be talking about provision for bad debts. I'm sure most of you have encountered this transaction, but then you didn't know exactly how we're supposed to deal with provision for bad debts. And this is exactly why we are having this lesson, so that we can be able to solve some problems that you might be having with regards to provision for bad debts. Now, before we go into details of the lesson, let's just get to find out what exactly are we expected to do. Okay, I'm just gonna erase this, but we have some learning outcomes that we should be able to achieve, which are currently displayed on the screen. I think this is also because we're having load shedding, so the system is a bit slow, but let's work with what we have. So these are the learning outcomes that we are expected to achieve. By the end of the lesson, we should be able to provide history of the concept debtors. When somebody talks about debtors, you need to be able to understand where does the word debtors come from. How did we end up having the word debtors? Okay, so you need to be able to provide the history of the concept debtors, and you also need to be able to describe the prudence principle. And then you must also be able to define debtors, bad debts, provision for bad debts, and provision for bad debts adjustment. And you must also be able to calculate the new provision for bad debts. Okay. Okay, let's go into what exactly are we supposed to do. Now let's just start by giving the brief history of the concept debtors control. When we talk about debtors control or debtors, we are talking about the people who owe the businessman. And businesses ended up having debtors because there was a time back in the olden days where business were only selling goods on cash. But unfortunately, people could not afford to buy some of those goods. And as a result of that, businesses were left with having a lot of stock on hand. They were left with a lot of stock remaining. And because people needed to have access to goods and businesses needed to sell goods, customers pleaded with businesses to say, okay, how about you allow us to have access to your goods early, and then we pay you at the end of the month. And maybe you might consider charging us some interest. And then as a result of that, businesses ended up having to agree with the customers to allow them to have access to those goods and services, so that businesses can be able to sell and have cash at the end of the month. Remember, as a business, you don't want to have a lot of stock on hand. So because customers were willing to buy on credit, and then as well as paying at the end of the month with interest. Businesses ended up having to agree to that, and as a result of that, businesses ended up having to come to some credit terms. They ended up having to come to some agreements. Remember, when somebody buys things on credit, they firstly have to sign the credit agreement. So it comes from those days. So those credit agreements included things like the terms and conditions of paying. What will happen to you if you don't pay? If you pay early, are you going to get discounts and so forth? So those agreements will stipulate how exactly customers are going to pay businesses like for the goods that were bought on credit. Okay, so which is why today we have what we call credit purchase. Today you can go to a store and buy goods on credit and pay for them at a later stage. So this is where the concept that has come from. The second thing that I want us to talk about is the prudence principle. Now, what the prudence principle says to us is that out of these people that we've provided goods to on credit, there is a possibility that some of these people may not be able to pay us. So at the end of a particular period, we might want to consider writing them off because we will not receive money from them at the period that we had expected. Like, for example, maybe let me use you as an example. You probably have some friends who like to borrow money from you, and then some of them, they don't pay you, and when they don't pay you, you end up having to cut them and forget about them because you feel like they don't take you serious or they don't respect you. All right, like, I don't know, but for me personally, that's what I've experienced. So we end up having to cut those people because they don't respect us, they don't pay us money when we've borrowed them money. So even in the business, there are some customers that when they want to buy on credit, they are convincing, finances look okay, everything seems fine, but along the way something happened, maybe something like somebody losing their job, and as a result of that, they end up being unable to pay, which results in us having to write them off. With that being said, so what the prudence principle says to you is that you should write off such people with the hope that one day they might be able to get some money and pay you. The next thing that we also need to talk about is some basic concepts that are very important in this topic. We have debtors. Like I said, that debtors are people who owe the businessman. These are the people who have bought things on credit from the business. And we also have bad debts. Bad debts are the kind of debtors who do not pay well. Some of them, they omit payment, they take some time to pay. We ended up having to write them off, and so forth. So these are you can look at them as debtors with a bad credit history. These people don't pay well, they don't honor their debts. So this is why we call them bad debts. And then we also have provision for bad debts. Now remember, as a business, when you sell goods on credit, there's always a possibility that some of your debtors may not be able to pay you. So what you do as a business, you create some fund aside to say, okay, this is the money that we will use just in case those debtors don't pay us. So it's more like your stand aside money, your standby money, just in case those people don't pay you. And we also have what we call provision for bad debt adjustment. Now, in terms of provision for bad debt adjustment, what happens is that sometimes provision for bad debts adjustment can be an income. It only becomes an income if the new provision that we have created is less than the provision that we had at the beginning of the year or at the beginning of the month. So comparison between the two. If the new adjustment is less, we have income. If it's more, we have an expense. And then the other thing that we need to talk about is calculation of the new provision for bad debt and the provision for bad debts adjustment, which is what we touched at the beginning of this lesson. So let's go into the information and just find out what we give it. Now, firstly, what they want us to do on question 1 is that we should be able to calculate the new provision for bad debts, and we must also determine whether provision for bad debts adjustment is an income or an expense, and which this relates to what I mentioned earlier on, to say that like when the new provision it's less, provision for bad debts adjustment will be an income. When the new provision adds more, provision for bad debts adjustment will be an expense. Okay, but let's not focus on that for now. Let's go into the trial balance and just check what information we are given. Now, if you check on the trial balance, we're given two amounts, the one for debtors control and the one for provision for bad debts. In order for you to calculate your new provision for bad debts, sometimes you might need information about the debtors control, or sometimes they may just give it to you, and all you would have to do is to determine whether we have provision for bad debts adjustment as an income, or we have provision for bad debts adjustment as an expense. But in this case, in this example, provision for bad debts, we have to calculate it. We just given the debtors control and the whole shandies that affect it. Okay, so we need to look at that information so that we can be able to calculate the provision for bad debts. Now, we are told that debtors control on 1 March at the beginning of the year. Remember the end of the year here, that's 28 February. They just told us that the year ending 28 February. And then we know that this trial balance is from the books of ABC traders. So you need to firstly establish the financial period, just so that you can be able to know whether the information that you're given is an opening balance or what. But how did you know whether something is an opening balance or a closing balance? If it's an opening balance, you will see by the first of something, like for example the 1st of March. And then if it's a closing balance, you will see that the date that they've given you is at the end of the month. So that would mean it can be at the end of the month or at the end of the year. So that would mean that what you're given there is a closing balance. It has already been adjusted. But in this case, our debtors control, we are given it at the beginning of the year, which is 1 March. And then provision for bad debts is also at the beginning of the year, which is 1 March. Now, you also need to be able to differentiate. Yes, is debtors control an asset or a liability or expense or income and all that? You need to be aware of that. In this case, our debtors control is always an asset. Remember, debtors are the people who owe you money. Anyone who owes you money is an asset to you as the business. Provision for bad debts, it's not a liability, it's not a capital account, it's an asset, but in this case it's a negative asset. Okay, the reason why it's a negative asset is because it reduces the balance of your debtors control. Remember this provision, you must take it out of the debtors control balance when you do your notes, but we're not gonna get into that today. So this is why, don't be surprised when you see provision for bad debts on the credit side. This is because it's a negative asset. Now the adjustments are saying that Bibalo, who was owing the business 3,500, settled his account by depositing funds directly into the bank account of the business. Now remember that as a business, you can decide to say you collect hard cash from people, or they can pay you directly into the bank account. So in this case, this person paid funds directly into the bank account of the business, and this person was a debt. In the second transaction, they're saying that the debt of Armakaya amounting to 1,000. Here, it's a mistake. Unfortunately, the document that I was working on could not say due to load shedding. So, but we can just write must be written off. Must be written off, so that you can know what exactly are you supposed to do. So this means that this account, this amount of 1,000 must be taken out of debtors control. Okay, now the third transaction says that provision for bad debts must be adjusted to 7% of the outstanding debtors. So this means that provision for bad debts must be adjusted to, we need to find out first what is the amount of outstanding debtors. This means we must adjust it to the latest balance. Okay, then when we adjust it to the latest balance, we take into consideration the people who paid, the people who were also written off. Okay, mostly when you are asked to do provision for bad debts, you will see these transactions on the adjustment. When you do your income statement, you'll have such transactions where somebody pays, somebody who was owing pays, and then we add off someone, and then they now ask you to create the new provision for bad debt. So the information doesn't really change. Like, that's mostly the same. If I was looking at some question papers, I realized that these things don't change that much. So if you master this, you'll be able to also deal with the adjustments. I'm having difficulties with breathing. I don't know why. So please don't be surprised when I breathe heavily. Now, the first question, we are asked to calculate the new provision for bad debts. Now, when you calculate the new provision for bad debts, like I said, you must update your debtors control account, because the percentage of the provision for bad debts is calculated on the debtors control account. So what we need is the opening balance of the debtors control account, and then from the information, the opening balance, like I said here on 1 March, this is the opening balance that we need. It's 40,000. So we need that 40,000 to be able to calculate the new balance, okay, or the new provision for bad debt. So we're gonna take that 40,000, and we now check, is there anyone who paid who was owing? If there's anyone who paid who was owing, we subtract them out of the debtors control account, because they no longer owe us money. So if you go to the transaction, you will realize that we have the Bibalo who was owing the business 3,500, who paid his debt. So we must subtract that 3,500. So here it's gonna be minus 3,500. Okay. Now each and every time when somebody pays, somebody who was owing us pays, the process goes like this. We say debit bank, and then we credit debtors control. The reason why we are crediting debtors control is because our debtors are reducing. So if you check, our bank account is increasing by 3,500, and then our debtors control is being reduced by 3,500. So you must always do the effects of the accounting equation, so that you can be able to tell how accounts are supposed to be affected. In my information, I said that debtors control will be credited. So this is why from the debtors control we are subtracting 3,500. If you go to the bank account, if we're expected to create it, we were gonna add this 3,500, but unfortunately we're not dealing with the bank account here. So already we showed the effects of that payment that was made by that person. Remember, this person deposited the funds. Okay, so this person deposited the funds, and then they're saying directly into the bank account of the business. So this person probably went to the bank or to an ATM and just made some deposits. Okay, and you must also remember the amounts. So we know that the accounts that are affected in this case, we must ask ourselves, Bibalo, what is our relationship between Bibalo? What is the relationship between Bibalo and us? And it's Alana Young, and then because they're saying that this person was owing the business, already they're indicating to you that this person was a debtor of the business. So you can already see that debtors control as an account is affected, and then the other account is the bank account. So you can already see that there are two accounts that are affected. So you must know how to identify the accounts that are also affected so that you can be able to create this new provision for bad debts adjustment with understanding. Now the second transaction says the debt of B Makaya amounting to 1,000 must be written off. When somebody is written off, it means that this person will not be able to pay us, which is what the prudence principle says. It says that we should write off debtors with the hope that one day they will not be able to pay us. At this moment, this person doesn't have money. We've probably taken them to credit bureau. They are blacklisted. They cannot afford to buy anything. They don't have money to pay us. So we cannot keep somebody who doesn't pay us in our books. We already know that we will not receive funds in a long time from this person, and this person is blacklisted already. There's nothing that you can do. If they can't pay you, you have to write them off. And this is why some businesses, what they do, they take loans, no, not loan, like they take insurance on their debtors, and then in the event where the debtor doesn't pay, the insurance that business has taken covers the debt that was supposed to be covered by the debt, and then that loan, that insurance company will pursue that debt. Like they will go after them. When they have money, that insurance company will claim first the money that person was owing. So such things they help in the business. Think about this also in reality. You have some friends that you know that if I borrow this friend money, this person will not pay me, and you end up no longer wanting those funds from that particular friend because you know that you won't get that money. You write them off, and some of us, we go to the extent of cutting them off out of our lives because we feel like this person doesn't respect us. So this also happens in real life. So now we need to be able to show on the accounting equation also how does this affect our accounting equation, so that we can know which accounts are we supposed to do the deductions on or the subtraction on. Okay, now so we know that each and every time when somebody is written off, remember here on the information we are writing off someone. We are writing off someone. Every time we write off someone, we say debit, bad debts, and then we credit debtors control. What was the amount? The amount from the information is 1,000. So this means that this person at this time will not be able to pay us this 1,000. So if you go to the bad debts account that we have on the income statement, you will realize that when this happens and we are given a task to do the income statement, you'll realize that we will take this 1,000 and add it to the bad debts that we have. So this means we're saying that our bad debts account is supposed to increase, and it's true, it's supposed to increase because this person will now add to other people who could not pay us, and then the debtors control account is credited because these people will not be able to pay. So when people can't pay, you take them out of your books. Okay, you take them out of your books, and then maybe in the future when they have money and they pay you, you will then have them as bad debts recovered. Think of it in this way: bad debts are those type of debtors who do not pay well. Sometimes they do not even honor. It's actually debtors who don't honor their debts. These people, they don't pay. So think of them as debtors with a bad surname. And when it happens in the future that they get some money and decide to pay us, we change their surname to their bad debts recovered. So these are the debts the debtors that we have lost, and now they have paid us, so we recover them. We had lost some funds because they could not pay us. So now when they pay, we recover those funds. Hence we call it bad debts recovered, and it will be part of your income. So in this case, we also supposed to subtract this 1,000 from the debtors control account. So we're going to come here again and say minus 1,000. So this 1,000, after we've done everything that affects the debtors control, remember we've taken into consideration somebody who paid and someone who was written off. So there's nothing else that we can include. So this will give us the closing balance of the debtors control, which we must use to calculate the new provision. Okay, and then it will be equals to, so if you take 40,000, you subtract 3.5 and then you minus 1,000, you will get 35,500. Okay, so now what we've done, we've answered we've shown we only got the balance of the new debtors control account. We have not answered this question. So now let's go to the transaction. This question will help us to answer this transaction will help us to answer the question. The same provision for bad debts must be adjusted to 7%, and if you check here the keyword, it says to 7% of what? Outstanding debtors. This means these are the people who will now be owing us after taking into consideration those that were written off, those who recently bought on credit, and those who paid. Okay, so now we want 7% of the balance, the latest balance of the debtors control. So we're going to get when we do the new provision, we're going to say let me say, so the new debtors balance, new debtors balance is equals to 35,500. So we're going to calculate the new provision on this, and then we can maybe say new provision, so that when you watch this you are able to recall new provision. Let me try to use a different pen. Let me try to use a different pen so that we can be able to see that we're doing something new now. So the new provision is 35,500. So we're going to say 35,500 multiplied by 7 over 100. It will give us the new provision that we want. So 35,500 multiplied by 7 over 100. Remember, when you calculate the new provision, you must be given a percentage. Okay, they must tell you how you're supposed to calculate it. So 7% of 35,500 is 2,000. Is 2,485. Okay, so this is the new provision. So now if you compare, this is the new one. If you compare, you will realize, but I will show you that when we go to the other question. So we calculated the new provision. So this means this is the 2021. this is the closing balance at the end of the year. Our closing balance on 28 February 2021, I think, yeah, it's 2021. Or no, man, here it's supposed to be 2021. You can't have 2020, it's 2021. Okay, because if the opening balance was on 2020, here it would be 2019. So here it's supposed to be 2021. So you must pay attention to such things, and then when you see anything that's funny, you must ask whoever is there invigilating, so that they can provide clear answers on that. So now the next question wants us to determine whether provision for bad debts adjustment is an income or an expense. How do you know whether it's an income or an expense? You must compare. You must compare. So now let's find out how much was the old provision. So the old provision was, you'll normally get that information from the trial balance. So the old provision was 3,500. And then the new provision, I think it's 2,485. So you can already see, if you compare, you'll realize that there's been a decline from here to here. There's a decline. So this means if we were to do the, what do you call it? If we were to do the, if we were to show this on the, if we were to show this on, what do you call it? If we were to show this on the accounting equation, it would tell us that provision for bad debts adjustment is an income, because remember, provision for bad debts adjustment becomes an income when your new provision is less than last year's balance. Okay, so now let's maybe try to get the difference here. 3,500 minus 2,485 is equals to 1015. So the difference is 1015. So this means our new provision declined by 1,050, which is a lot of money. It means that instead of putting aside 3,500, we've now put aside 2,485. So we have actually saved 1,015. So this becomes an income for us. So now we need to show this using like, you know, showing which account should be debited, which account should be credited. Okay, so now because there's an income, this means we are going to debit provision for bad debts and then we credit provision for bad debts adjustment, and then the amounts are 1050. So I'm already seeing that when I created the T account, provision for bad debts adjustment, it should be an income. Okay, it should be an income. So we're going to write the information and try to see if this will work. So let's start with the T account. for provision for bad debts. Provision for bad debts adjustment. So it means that on the credit side here, we're going to have provision for bad as 1015. Okay, so you can already see we said that provision for bad debts adjustment credits provision for bad debts. So when we go to provision for bad debts, we're gonna come here. When we go to the provision for bad debts, the provision for bad debts account must be debited to show that it is declining. Okay, remember, if you check provision for bad debts here on the trial balance, it had a credit balance, because it can't have a debit balance, because if it has a debit balance, it will not reduce the, what do you call it, in the meantime, don't miss me too much. So as we continue with this, I just wanted to confirm, I wanted to get a book so that I can be 100% sure, because you know, sometimes when you teach people something and you make a mistake, they will never forget that. So I went to the book and to confirm. So yeah, the information that I have, provision for bad debts is definitely on the credit side, which is correct. This is what we have done. It's on credit side, as you can see here. So let's continue now with the part of the lesson. We were trying to figure out how we were going to record it. So remember, I showed you this part where provision for bad debts adjustment was an income, which is an income according to the information that we have. So now I want to show you a part where we do provision for bad debts, looking at how it will be affected. Okay, so let's get into it. I want to use a different pen so that you can be able to recall. We will be done, I think, in about the next 5 minutes. So let's just check. So now if you go to the information, you realize that provision for bad debts, one thing, please, when you write, please try to show the dates, all the information that's necessary. Yeah? But for me, I would do shortcuts. So the balance brought down here, it's from the information we have balance brought down as 3,500 again. From the information as 3,500. So you must show this also. 3,500. So we want to be able to see, will provision for bad debts really decrease? Is it going to decrease now? Okay, remember we said here that on the information we said that provision for bad debts, the part will be reduced by, because it's debited, this means it is reduced. We said it will be reduced by 10,000 and 1,015. So we want to check, are we telling the truth? So what are we going to do? We're going to take the closing balance and put it here. Remember, it must still be on the credit side. So we're going to take the closing balance and have it as a balance carried down here. Okay, so the balance carried down will be the new 2485. Okay, Remember, before it becomes an opening balance, it has to become a carried down first. So if you check, we're saying that the balance of provision for bad debts, the new balance will be 2485. I get it. But now if you check, when you check on the information that we have, the bigger side is on the credit side. I get it. So this means that the balance will still continue to be on the credit side. So what we're supposed to do, we're supposed to figure out, remember, since we have this, we have the new the new provision. So we're looking for the provision for bad debts adjustment. So this means the big side will be this, because already we know that our new balance is less. Okay. So we're going to have 3,500 here and 3,500 here. You can already see this side is big. So here we're going to have provision for bad debt adjustment. I want to take you back to the information. Here we said that provision for bad debts adjustment will be debited by 1050, and then the account that will debit it is provision for bad debts adjustment. And then when you go to provision for bad debts adjustment, provision for bad debts adjustment will be credited by provision for bad debts. So this means here, provision for bad debts should debit provision for bad debts adjustment. Should be debited by provision for bad debts adjustment, which is what we said here. Remember, you said you're going to debit provision for bad debts by 1015, right? And then you'll credit provision for bad debts by 1015. So provision for bad debts adjustment is indeed credited by 1015. So we've shown one side of the double entry principle. So now we also said that provision for bad debts will be debited by 1015. So it must be debited here by 1015. So now, remember, in this case, let's say we were able to figure out the difference. We figured out that the new provision for bad debts, the difference was 1015. So we were still going to look for this. So what I did, I took the information that we used here. I already knew that the new provision is 2485 and the difference is 1015. So that's why I have the new provision here. This side, they should be equal at the end of the day, and they are indeed equal. If you add this plus this, it will give you this. So, and we said that the closing balance for the end of the year should be the opening balance for next year. So, which is why we're going to have balance brought down here, brought down as 1015. So we have already shown, we have determined, so you can say that if you want to put it in writing, you can show that the new old provision, you can say the new provision which is what 24, can maybe put 2485 is less than the old provision. You must write new provision for bad debts. Okay. The old provision is I think 3,500, and then you state that therefore the new provision for bad debts declined by R1015, and then you can show in bracket R3500 minus R2485, and then you are done. That's all you have to do. But then remember, when you answer this in your exam, you'll have to do this on an income statement. So in the income statement, what you're going to do when it's like this, you're going to have your provision for bad debts adjustment under your other operating income. Okay. So I think we've exhausted everything. We've covered everything. Let's just summarize what we've done. So we have provided the history of the concept that is control. We have also described the principle known as prudence principle. We have defined debtors, bad debts, provision for bad debts adjustment. We have also calculated the new provision for bad debts and the provision for bad debts adjustment. Okay, so now we have already achieved all our learning outcomes. If you watch this, should you have any question, please don't forget to get in touch with us. Should you maybe want us to do something, don't forget to use the details that will be displayed at the end of this video. And to all those who are writing exams, I just want to wish you success in your examinations. Stay blessed. God bless you.